Thank you very much, Sean. Happy Easter, everyone. I hope you've already had a great weekend start and it will be a wonderful one going forward. Um, and thank you again for being with us. As always, we start reviewing the economy, the markets, and again, our new episodes on emerging markets, which I hope you find them useful and of value. We will have few lessons of the week and one idea about trade of the week, what had happened, the screen of the week, and the earnings, upcoming earnings, especially with the way we had a class, a few days ago on using option strategies on earnings. So with the really heavy hitters coming up in the next 3 weeks, I think that would be timely. So we started economy. It was a busy week last week. And I mentioned as far as the central banks and all these Fed members and all this different country central banks going around having speeches, you can see how concerned they are about the effects of inflation and obviously the usage of interest rates as a tool to hopefully reduce that. And the effects of it, the whole economy. On top of that, we still have the geopolitical events going on, and as you could see, and we had talked about how just these geopolitical events and the inflation is affecting the economy of developing countries, such as like Peru. We've had people up in arms. They want to overthrow their president. And then we have Sri Lanka, which is really, it's rated junk right now, and they're meeting with IMF. I mean, it's been a lot of obviously effects from just what is happening from just the energy and food prices. And food is a huge element and a huge factor in running, again, especially in emerging economies. So again, last week was busy. This coming week, really, there's not much going on from the US point of view. So there's going to be Fed chair is going to talk on Wednesday, I believe, and that's about it. So there's not a lot going on. So usually that's what happens with the lots of earning coming. So maybe that's where you can put your focus on and see if there is some opportunities there. But last week was an important week because, again, inflation being the forefront of all the subjects, we had the consumer price index, we had the producers price index, we had the retail and numbers. So the CPI, which is a consumer price index, came out last Tuesday, and it was up 1.2% month over month. And it was 8.5% year over year, which was the highest since December of 1981. So it's over 40 years, this was the highest. Now, we can, as you will see, we're going to connect all these, why the inflation is becoming a factor. Now, this is, again, I think there's a lot of good things are for free. This is from the Bureau of Labor Statistics. And, they come out, they have really nice graph. The Fed, the central banks have really have a lot of good information. And that's what I try to get my informations. And they are firsthand, so there's no filtration. So as you can see, this is their report. They come out, we were up 8.5% since December 1981. And it shows in the past 12 months what has been a month over month. And again, the biggest factors have been for the CPI is the energy, the food. But I think the number one you have to really emphasize is the housing, especially the rental. And the rent is not just you going out and rent, because it is equivalent if you were gonna rent your house, how much of an increase will that be? And that's a big part of the CPI. So you want to pay attention, especially with the way the housing prices have gone up. The rents haven't really stayed up with it. So that's the factor, is about 30% of your CPI. So you want to pay attention. Of course, we emphasize more on, again, the energy, like the gasoline and the heating, but that's something you want to pay attention. Now, the second part of the equation was on Wednesday when we had the PPI numbers. And in my opinion, that's even more important than the CPI. Now, CPI, of course, it stands for the consumer. So you're the end results. It's the consumers who are using, again, they're the one who's spending the money based on, the wages they have, the income they have. They go whether they spend the money, they don't, but they're still consuming things. Now, the producer's price index is the actually beginning. So they're not the end of things. They are the ones who see how much of a factor this inflation has put on them, and they have to decide what kind of pricing they're going to choose. Now, the month over month, it was 1.4%, and it was the highest. It's been, I believe, the highest we've had in 11.2%. So what that means to us is the CPI basically will be lagging the PPI by a few months or some time. So the PPI, when it comes at 11.2%, especially if they have to pay for the higher, again, energy prices and the raw material and other things, that's a warning. So we want to, again, pay really good attention, not only in the United States. And that's one of the reasons I hope you follow our trading ideas of the week. If you notice, my whole idea, when I say ideas, it's not just, oh, come out and give me like should I buy corn or should I buy wheat? The idea is to understand the totality of what's going on around the globe and why the PPI and inflation numbers and retail numbers and balance of trade, they are important because, again, the global economy is playing a much bigger role than it did 30 or 40 years ago. So that's why I want to pay attention to PPI. And again, because that might have a domino effect. Now, the third part of the equation was we had the retail numbers came, and on the surface, they looked pretty good. Basically, what happened was the retail sales actually really met the consensus. They were up 0.5% for the month. And basically, if you look at the upward revisions on the past months, it was 1.2%. And 10 of the major 13 sales categories were up in March, led, of course, by gas stations and general merchandise stores. So again, on the surface, it looks good. You say, well, it's healthy economy. It seems like the consumers are spending. But this is, I want you to pay attention. Again, we are up 3.5% to 4% on annual rate for Q1. But I put this in red because I think it's very important to understand that the retail sales, they do not adjust for inflation. And what I mean by that is, the sales of gas stations, they rose 8.9% in March, of course, because of the higher prices. As a matter of fact, a lot of gas stations was up like 19.7% on an annualized basis when we look at the thing. It was like some of the gas stations, it was month over month. So basically, when you look at that, of course, it makes sense that retail sales were up because of the inflation was up. So we had no choice. We had to go buy gasoline. So the idea is you don't want to look at things just on the face value. They want to do a little more due diligence, digging a little more behind it. So basically, when we look at it as adjusted for the consumer price index overall, retail sales actually declined 0.7%. So this is the factor that we have to take into consideration as far as there's this word of recession you can hear. And we've talked about the inverted yield curve and all that, but you do hear, here and there now, and it's getting more frequent. That's one of the reasons how much of the inflation is going to affect the behavior of the consumer. So this was important. And although, again, retail sales are up 6.9% from a year ago, that pace lags inflation. We just found out CPI is at 8.5%. So we want to keep up with that. Now, I put down these in blue, and I was looking at the contradicting forces going along. So in one way, we have these rising wages. And when we have the rising wages, what happens, obviously, that will help with the spending. So people still feeling good, the unemployment numbers are low. So that's one factor which helps with the retail sales. The opposite is obviously the end of the stimulus checks, the easy money is gone. So there were a lot of easy money spent in different ways. People were buying toys or whatever, but that kind of could negate some of this. On the other hand, is the retail sales, which are, again, with the inflation, they might slow down. I just mentioned, again, once your wages are not keeping up with what the demand, as far as what you want to buy, then the retail sales could soften. On the other hand, with the COVID, again, looks like, again, we're looking at the United States, of course, it's affecting China quite a bit, which is going to have could have a longer term effect at this time. At least for USA, things are opening up. People are traveling, the flights, the hotels becoming very expensive. And, people are, with the spring being here, and then the school will be ending in 6 weeks or so. So people are going to start traveling. So the service industry, on the other hand, they are going to have a positive effect. So you can see, as I said, there's a contradicting, or kind of the forces against each other. So we have to do a balancing act. So there is no really clear force going on right now. Looking at the bonds, of course, we look at the curvature of the yield, but this is what I want to pay attention. Number one, we look at the long-term rates, right? So basically, these are the 10-year rates. And I want you to pay attention. This is where we were beginning of the year, about 1.7 on 10-year note. We are at about 2.7 right now. This is a huge move. And it's not just the United States, as you can see globally what has happened. The other thing I want to pay attention is the corporate versus the high yield, which is a lower grade investment, lower investment grade, the spread. So we want to watch the spread to see how much of, as far as a credit risk, the market is willing to take. So these are the things, again, I want to be familiar with it, because that tells us about the health of the economy. Now, what happened in the market? We start with sentiment. I don't think I've seen, this is the AAI. This is one of the lowest I've seen on the bullish side. Again, there's that fear going on, at least from, these are really AAI members are more seasoned investors, but they're, again, becoming very reactionary. So we see that the bear market, this is as of Wednesday, they are at 48.4%, way above, that's one standard deviation above the bear averages. And the bulls, I mean, almost 1.5 to 2 standard deviation lower, they're at 15%. Now, what does that mean? Again, if I mentioned last week, again, I see the light at the end of the tunnel. If you are learning your fundamentals, you understand the intermarket relationships, you understand how to work with the companies and analyze them and all the factors involved, finally, we might have a little sanity in next couple of years or so. So your investment decision-making could make sense. Up to now, even you look at, especially last 12 years with all the easy money, quantitative easing, the money was like a river, lots of forces, and they would go anywhere they wanted. And sometimes it was very difficult to bring logic to it. So what happened was that, like, the sentiment really sometimes didn't even make that much sense. It was short term, they would, but now people going back again with the markets, we don't know what's going to happen this year or so, but having a little sanity, at least from the point of understanding that the factors are relevant, then I think these things might make sense. So right now there's a lot of fear, and what happens, we talk about seasonality. It has been a bad start for April, but what we could think of, as I mentioned last week and 2 weeks ago, April historically is, if not the strongest, like the second strongest month. It hasn't been, and usually like the April 7th, usually it's the bottom of it. It has not. The only time April was negative since 1997, it was on a losing years like 2000. So that's something we should think about. Although they were up on in 2007, 2008, 2009. So April was up a month while the years were down. So the strongest path we found out, and I mentioned one of the reasons April seems like a strong one, especially in the past, was because of the tax season and because of the tax filing. Usually by the 15th, most of the states, and they have to file. This year is obviously, it is a little later, April 18th, because of the obviously Easter holiday. They most people talking to their accountants, and they have to open up the retirement account like IRA. They have to contribute, so usually you get a lot of liquidity and you get a flow of money. So we shall see if this year will be any different or not, but generally starting this coming week, the markets like to, at least from the point of view of, again, middle of the April, sometimes they do have a bounce, and that might be one catalyst. Obviously earnings, big ones coming up, they could be another catalyst. Of course, we had the financial sector started last week, and they were disappointment, which we'll discuss. So it can go either way, but that could be one of the catalysts to go along with the sentiment. And this is where we stand as far as the CNN. We are in a kind of a lower end of the neutral. As you can see, we've had a down month already. So from the technical point of view, there's a lot of weaknesses, but from the sentiment, we are seeing that, we are more to the neutral and fear than more of a greed side of things. So we want to keep that in mind. So what are we talking about? Well, this is what happened last week. Again, Dow Jones has been the more stable of all the indices. So they were down 0.78% last week. Now the NASDAQ, these magic number, it was like 14,000. Now that 13,000, the round numbers becoming magic. They were down again, big time. Mega caps, 2.62%. S&P 500 was down 2.13%. Again, we had the financials. And again, energy is helping to keep the things up, but they're not a big segment of this. So, but when we go to commodities, gold was up 1.51%. We are at 1,970, almost $5. Copper was pretty flat. And the crude oil, we discussed it last week. Again, there was a base, I would say 92, 93, and it just, you cannot have a short-term band-aid for a long-term problem. So basically, opening up these strategic reserves, it makes you feel good. But it is not a solution. So they were back to almost $107. So basically, when we look at from the high to low, we see that Dow Jones is 6% below where it was the high of January 4th. S&P is at 8%, and NASDAQ is back, in a correction. It's at 15.67%. So it's been very difficult for the, again, NASDAQ stocks. Oil is down 13% from March high, but it is up 40% from January 3rd. And it's interesting, again, the market as a whole, when we look at the general, it was like down 1.76%. But we go back risk on and risk off when it's like things are getting a little risky and people are being cautious, then the money obviously it flows to, as we can see, to the value side of things. So the growth was down 3.3% in the large caps, and the value was only down 0.9%. When we go to mid cap, on the other hand, you see that actually growth was down almost 1%, but the value was actually positive. Small caps actually were positive last week. the growth was flat, but the value was up 1.34%. So when you see a little nervousness, the money in the past few months we've talked about has gone to more of a value segment of, or value side of things and the growth. I also wanted to review again year to date. Let's take a look at what are the big movers. And of course, again, commodity oriented, we have energy and basic materials. So they've been the big winners. Utilities, again, from the defensive side of things, they're still up. And then defensive, consumer defensive, and then we go to healthcare. They've been up. You go to technology, of course, they're the big losers, and the consumer cyclicals and the communication services. I also wanted to bring this again because we're talking about the whole economy. I want to relate everything together, especially talk about central banks, how the central banks are affecting all the decisions about their outlook, what they're seeing. And again, most of these central banks are behind the curve. They did not act properly at the right time. So a lot of economies are suffering. On top of that, you have, again, the geopolitical forces. We see the dollar has been a natural winner. So basically it is based on safety, but also the higher interest rates, it attracts more money. So, the Fed being, the first one as far as, increasing the rates by 0.25 in March, talking about another 50 basis points in May, and on and on. So the dollar has become the natural, grower as far as the currencies goes. And it's very interesting for year to date, dollar is up 9.79% against Japanese yen, because Japanese government, they still want to suppress the interest rates. They are happy with the lower yen, and they're happy that basically their currency is down and the interest rates are down because they still want to stimulate. They've been in a almost 30 plus years of recessionary pressure. So it's constantly trying to stimulate. So needless to say, you see that of course British pound against Japan was another winner, but a lot of US dollar related is a winner, except you see the US dollar against Canada. The US dollar is down 0.27%, and that also should make sense. Canada being, again, the commodity oriented, and especially with the energy, their currency did well because of obviously the demand for their product. So that's the only one. Other than that, you see everything is down, and you go to Euro USD, and you see that Euro is down 5% against dollar. So you have the dollar strength, but the Euro hasn't increased their interest rate. So obviously that, and we will discuss that about this. We talked about the Central Bank of Europe coming with their decision on Thursday last week, what they were going to do. And, the President Lagarde, what the plans she had. And since they didn't increase the interest rates, then Euro actually lost its value because there's no reason, interest rates are low. So the money came back to dollar. So that's, again, the relationships you want to get more comfortable. Going to the charts, again, we look at the fib numbers, and you see how this 8-day moving average has been a cap for us. Every time we've tried to break it, and now we have the 20-day moving average. So, and also 50, you see we are really consolidating here. It's important, this area is very important for next week, because what we want to do, when you do have this contraction of the moving averages, generally it doesn't bode well if the direction. So the thing is, it will be a good idea, and it will be good to see if they can revert and the short term starts going back up, because if they continue going down, this is from the technical point of view. So it's interesting from seasonality. We talked about April 18 might be positive. So you want to keep that in mind. But from the And then the sentiment, we saw there's a lot of negativity, so that also could be positive. But from the technical point of view, we are in a difficult position right now. There's a lot of resistance. Now, if these moving averages start expanding, that will tell us there's a way down. The only thing is we've had this support in this area. So, about, we talk about 43.50, 43.30 actually would be, or 43.36 or so, will be actually good support at 38.2%. But this area should hold. Otherwise, we could actually fulfill. When you look at the weekly, we can see that S&P is looking like trying to build a head and shoulder, and which is not positive. So whether this is going to go to that shoulder or not, this week will tell us. Again, we have a lot of big earnings coming, so we want to be aware of that. When we look at the Bollinger size, you see we've been kissing the lower edge of Bollinger Band, but we are below 18 and 100-day moving average, which is not positive. Again, we have to, if you want to have a positive month, we have to break this. We are embedded, so that's not positive. MACD is down, that's not positive. So from technical point of view, we have problems. Now, NASDAQ has been the weakest of all of these. Now, the question I have to actually address right now is, and I did it on purpose. I was going to do QQQ cash rather than futures. What happens Friday? As you know, it was majority of the markets were closed in the Western world, and because of Good Friday. So what happened in this case is the trade station. This is Thursday's candle. That's the close. Because there was no Friday, there is a double candle. So please ignore this, and it will dissolve itself with the next few days. So it affects the numbers a little bit. It's neutral, but that's why you will see in the next few charts that they are actually, it's the same candles, but that's because it was closed. But you see again, we are on a big support on NASDAQ at 890. So we are sitting there, but we are below 18. We could not break through that 100-day moving average. So, and we are embedded, and MACD is down. So the same story. Russell has really been a range bound, but also Russell, we see that still under 18-day and 100-day. The question is, they touch their Bollinger Bands, trying to move up. And now we are oversold on the stochastics, and MACD is flattening. So we will watch Russell, and especially when we think about the value side of things. And then the Dow has been the strongest, all of them. But again, we're still under 18 and 100. We are oversold, and MACD is below, the trend is down, but it's flattening. I want to share again the mid-cap stocks. They are also oversold. MACD is flattening, and then we're still under 18 and 100. You see, every one of these have a weakness. The transportation was we talked about the leading indicator, and you see that they are actually started basing at our support line, and now they gradually are moving up. A lot of indecision, but it's a gradual moving up. MACD is still down, but it's trying to come up, and we are still embedded, but we're getting very close to the oversold. And the VIX, it's interesting that the VIX is also under 100-day moving average, but it's over 18 and over the support. We're turning down, so the momentum is going down. MACD is still up, but we want to watch this. So let's pay attention to this support. So if we break through this, the 18, that will bode well for the market. So, and then the VVIX still above its 18-day, it has been. And again, we got rejected at 100. The momentum is above 50, so that's good news, and MACD is up. So the volatility is still there. This is the story of, a story of every story, is the 10-year notes. As you know, this is how the mortgage rates are determined. and obviously that affects the housing markets. Although I still know people with cash, they're waiting for some kind of a opportunity to come back, but they don't see it at this time unless they want to live in a place. And I know obviously some of them are looking for like uh, uh, multi units, for instance. It's been difficult. So we see that 10-year, we hit above the Bollinger Bands, came back down, and then boom, we had a big jump on Thursday. We are embedded. The MACD is up, so there is not a lot in the horizon. I mean, the 3%. I was looking at 2.25, and then 2.5, and now we have passed the 2.7. Now you have that 3% is huge. If we go back, it's a long-term trend that we have to, or resistance. We'll see how that will behave. And consequently, see the 10-year note is below its 18 and 100-day. And although we are oversold, MACD is trying to flatten. Excuse me. So the same thing with 30-year bonds. Again, the weakness. So it just continues. And the financials, a couple of things. Again, with the rates, the spreads are not helping them. And of course, all these, the major banks came out. We will have Bank of America coming out Monday morning. So we want to pay attention. But we started with the JP Morgan, and then we had Goldman Sachs and Citigroup and Morgan Stanley and Wells Fargo. I will go more in depth with the lesson of the week about that. So you see the earnings started. We had a nice Wednesday, and then when the big earnings came on Thursday, they lost money on that day. Now here's the dollar. As we talked about, the dollar, it's still strong, broke that resistance, staying above that, embedded. MACD is up, so it's just going to continue. And gold also, it moved with the dollar, but then we had a big resistance, and then we hit the Bollinger Band. So I will discuss it more about like the gold trade, which I did it on Wednesday, and obviously it was not successful because we were at a resistance, and I'll discuss it a little more. And the silver is a little better than gold, and we are above the 18-day moving average. We hit the Bollinger Band, we came down. Now we are overbought, so we'll see next week whether we're going to embed or not. And copper, again, it's been pretty flat. You see the moving average has been flat, but look at this Bollinger Band. It's getting really narrow. So we shall see that energy is being built up. So we are oversold. MACD is, the momentum is down, but the trend is up. So we want to watch the copper. And the Bitcoin, its own world, has been flattening. They are embedded over, on the sell side. So, and then crude oil, again, these are double, so ignore this one. We just broke above the 18-day moving average. So the discussion was, would this go down more? Well, we went to oversold, momentum is up, and MACD just crossing, and we just crossed the 18-day. So that doesn't bode well for the price of gasoline. And the XLE, the energy sector, has been doing well. So expected moves, I will discuss it a little more actually in lesson of the week. You want to pay attention, please, to these expected moves. So look what happened on Wednesday. We went, and on Tuesday, actually, we went below the expected move on SPX, which was about $75, $76, came back up, and then Friday, again, we sold up and went just below that. So there is this tug of war going on with the expected move. QQQ stayed within its respected one, very close to that is lower edge. On the other hand, the IWM was the stronger one, and they went to the upper edge. And the Dow also went and hit the lower expected move and stayed inside. and it was the bonds that they broke down on Thursday. Gold, again, watch. So this is Wednesday, that's where the trade was. And again, I held my nose. I shouldn't, but probably would have been a good time to do either in and out, would have been a good trade, which I should have done, but sticking to my rules, I did that, and obviously it got rejected, and we finished right under. It wasn't a huge move. It wasn't like a big sell-off or anything, but still, I mean, the options expired worthless. So, but they did respect their expected move. And silver actually went up above, and as I said, it's been stronger than gold, and we closed above that expected move. Financials, as we discussed, they had a tough time, but they still respected the expected move. But Friday they came a little below that. And energy, again, respected. It's been just on fire. Okay, let's take a, I'm gonna have a little more emerging markets. So I'm hoping you're feeling more comfortable understanding these emerging economies, how they interact, how they affect each other, why some of the factors are more important. So when we do the trading ideas of the week, if you notice, I emphasize again the economic numbers. And last week we had few central banks coming up with their interest rate decisions. So what I did, I kind of put the different things, the decisions that they made last week to give you an idea how these central banks are combating the inflation. As I said, all of them are really behind the curve, and they're just reacting rather than acting. So rather than being proactive, they're becoming reactive. So I start with South Korea, and you will see a common theme here. South Korea's central bank raised its benchmark rate to the highest since August 2019 on Thursday. So this is again fight against rampant inflation. Bank of Canada hiked its benchmark interest rate by 0.5%, and they're at 1% on Wednesday. And again, high inflation. This was the biggest one-time increase in central bank rates since 2000. New Zealand, the RBNZ central bank, is the biggest rate hike in 20 years. And the Reserve Bank of New Zealand raised its benchmark by 50 basis points to 1.5%. Now, here's the question, and that's why I want to relate it to the euro. So this was Thursday, what did the European Central Bank monetary policy decided to do? They have decided not to raise the interest rate just yet. So there's that fear with the higher, on one hand, they have the higher energy price. On the other hand, they have this, again, very fragile labor market or economy. They're worried about the recession. So they have to really do a balancing act. So what they decided to do is they have decided to reduce their net bond purchases, which was that quantitative easing kind of thing. So that they are going to go gradually from euro 40 billion, they're going to, which is about $43.6 billion in April, to go to 30 and then to 20. So gradually they're going to reduce that liquidity. But the current interest rates will be unchanged at 0.5%. So no interest rate hikes. There will be 50 basis points, the way that it was really baked in the United States. So everybody kind of assumes almost with 100% certainty that it will be a 50 basis point increase in coming May decision. So they made the decisions. They know that Europe is strained due to war in Ukraine, and again they are also aware of the COVID restrictions, and basically that was the reason. So I want to give you a little collection of all these central banks' decisions. The other thing is, of course, every week I like to look at the economic data in different regions of the world. Today, what I want to emphasize is again on the currency side. So you see, actually, there's very few countries that they have actually surpassed United the dollar. Dollar has been strongest, but the Chinese yuan or RMB has been positive. Canada, as we noticed, is pretty flat. It's a little bit up. Indonesia is up, and as well as Brazil, we started tightening last year. And then when we look at Mexico and then when we look at Israel and then South Africa. So everything else is red. So the dollar has been the key as far as holding currency. Let's travel to Russia, because the Russian economy still is in the forefront. And, you know, with all the natural resources, the commodities, what we want to know is, how much power Russia has as far as, you know, we have this united front from the Western countries, but the world is not, again, it's not 1980s or 1990s, it's a big world. So I want to show you one of the reasons, and that was one of the reasons I didn't think the oil at this time, at least, is going to go down, is there's a lot of other partners for Russia, and they could use their obviously will be a buyer without concern about the sanctions. So this is a map of the countries, the governments who responded, and you can see obviously the dark blue is all the countries, which is mostly North America, Western Europe, and Australia, and Japan, and South Korea. Then you have some Western-leaning countries, mainly in the western part of the Latin America and Central America. And there's some of the African countries and some in Asia. But then we come here and we see that, well, there are a few countries that actually support Russia. There's no surprises: Venezuela and Cuba, Nicaragua, Syria, Eritrea, and Burma or Myanmar. So they are in, in line with them. But look, what is that Russia leaning? These are the big economies, so such as China and of course Central Asia countries. We have Pakistan, which they just changed their prime minister. There was the military asked the Prime Minister Khan to resign, and they brought Mazar. They brought Mazar Sharif, and he's like the new prime minister, which is more Western leaning. But anyway, there's a lot of countries in Africa which are basically leaning towards Russia. Of course, we have Belarus in there. And you see India is really neutral. So when you have India and China, which really are the 1/3 of the world population, are not on the side of, or at least they're not against Russia, you are going to have problems to have this united face and trying to really squish Russian economy. So I just want to share that with you. And also, this was interesting. This came, I mentioned it last month, but March 15th to 21st, you see how people in India answered the survey, and they about 40% approve of Russia invasion and 60% disapprove. But the Putin, you see, the Putin is not as much as Zelensky, but they are, it's pretty high that they actually, Putin's leadership over the past month has been, they've approved. So the second thing is going to the economic side of things. As you know, a lot of companies have been exiting Russia. But the interesting thing is, what do the Russians think about this? Now, again, it's a little difficult to get the correct answer, but this is a survey that we got, and then you see how many countries have left, withdrawn from all the businesses. Obviously, the majority of them in North America and Europe. There are some suspending, their operations. They haven't left, and And then when you look at still conducting business as usual, there's few in North America and Europe. We can see East Asia is big and Middle East as well. So the interesting thing was, what do the Russian citizens think about all this? And they do not seem to be concerned about the exodus. And this is as of April 11th. In reality, it says, will the domestic producers be able to replace? Yes, mostly or partially. So 85% think that they're going to be okay without all these foreign countries or companies. Will the suspension of foreign companies affect you and your family personally? A strong impact, but look at this: moderate impact, little impact, or no impact. So 83% don't think that's huge. Now, it's in the beginning, so perhaps I've seen that before, but it is, again, this nationalism is boiling, and it depends on who they're answering to. But still, this is the attitude at this moment. So, again, the fearing the sanctions, again, especially some of these foreign companies are leaving because of the backlash we talked about last week, as far as the consumer side. A lot of, dependency of Russia is on the auto industry, because there's a lot of parts coming from, it's the foreign companies and governments, and the clothing, footwear, and telecommunication also. But what the Russians think, they're optimistic that they're switching to homemade products and goods from Eurasian economy, union countries such as Belarus. Of course, the quality is not there, so they probably going to have rude awakening. But right now, the attitude is still they're gonna stick with this. So, and that's the reason I think, in my opinion, especially in the Western cultures, we see the world from our own prisms, and that's a mistake. And whether it's right or wrong, whether our path is correct, which most of the time it is for the well-being of the world, and individual liberties are important, and that's important, but we have to see the world in a different prism to see how these countries think about. And one of the examples I tell you, for the longest time, the Western world wants to bring democracy to Middle East, to Africa, and they have to be really primed to accept it, and it has to be internal, not external. So these are the things I think sometimes it is not, there's a lot of theories, a lot of academic involved, rather than really street smart, in my opinion. So moving on, I thought this is an interesting chart. So because Fed just had its first rate hike in March, that 0.25%, how does the EMBI, which is a JP Morgan Emerging Markets Bond Index, behaves, and how the MSCI, which is Morgan Stanley Composite Index, International Index. So this is what they have done since November 1997 to January 2022. These are the monthly returns. So they've done, this is what it is. So the point is, 12 months pre-hike in past 25 years, this is what the MB has done, which has been underperforming, both of them, the averages. So there's been that fear, obviously. The interesting part is, what do they do after 12 months, starting, which the clock started in March? So they have overperformed their average for the EMBI and the MSCI. EMBI actually overperformed the MSCI index. So isn't that interesting? Once the Fed hike has happened, the market's actually done well. It's all, again, we've talked about, buy the rumor, sell the news, or sell the rumor, buy the news. So now that it's done, there's that relief. So now they have to work on it. So again, we have this inflation, geopolitical things going on. So there's, of course, different factors, but I just, again, being a follower of statistics and history, I wanted to share that with you. moving on to complete different things, I thought since we are talking about just economy, well, let's talk about fintechs because that is part of our world. And I think the question came when we look at the traditional inflation in the past, I believe with the explosion of innovations in technology, that would be a neutralizing factor as far as the complete runaway inflations. We are so efficient. There's a lot going on. So basically, I thought, well, let's look at the fintechs in emerging markets, the top 20, and how much is the customer acquisition and servicing cost for these emerging fintechs? These are the 20 top ones in the different countries of emerging markets. And basically, we found out that based on the study of 20 listed emerging market fintechs, the median customer acquisition, it costs US $50. And the annual servicing cost is about $55 per user. So there's you can see there's a big difference from, from $2 to 974. So, and then the servicing goes from 2 to like 4 or 3. But it's just a tidbit to get you, again, I think in the next few years, you really want to be familiar with these fintech companies from overseas. It's granted, we think about the United States all the time, but there's quite a few obviously going on from when you think about China and you think about Israel and you think about, there's just so many other emerging countries with their fintech. So going back to ECB again, we talked about its rates hike. So I just want to break it down. This is the inflation. That's a concern, of course. They believe, there's a big consumer of energy from Russia, so that's affecting them a lot. So, and you see that energy plays a huge role when you compare March 2021 to March 2022. That's a big thing. And of course, food and alcohol and tobacco, they also play a big role. So it was a breakdown of what Europe is looking at. Jumping to something completely different, how the COVID and how the geopolitical things affect a country, affects a country's economy. So this is, I put down Mount Everest, or this is from Economist, Everest's unfortunate decade is Nepal. Now, Nepal, obviously, the tourism plays a big role. And they did have, unfortunately, the deadly avalanche in 2014 and 2015. And then we've had the COVID. So, I mean, traveling during the COVID. And, Mount Everest is, because of that, it has been a challenge. So now the war in Ukraine, on top of everything else, it has affected the Nepalese economy because a large share of the climbers hail from Russia and other European countries. And because of that, with the disrupted flight routes, most have canceled their plans. So again, I want you connect the dots, see how a country, just we're talking about hiking Mount Everest. It's not political. It has nothing to do with, what is happening with the inflation thing, but it does. You see how that gets affected. Now, the tourism department has just issued 204 permits this year in the climbing season, which is half of the last year, which was just opening coming from COVID. Now, they have 8 of the world's 14 peaks over 8,000 meters. So it's a big thing for the climbers. And the tourism is about 8% of the GDP. So what happened? That brought $300 million to Nepalese economy. And this is an interesting factor. These Sherpas, they make $6,000 to $12,000 per season. And of course, they have worked very hard, that's well earned. But a country's annual income is $1,090, and yet they were making $12,000 just per season. So that's affecting them. So I thought, again, you see how the world's so interconnected. So with that in mind, let's dive into a few lessons of the week. This is, I found I think it was 2018. I mean, I go through some of my archives and other things, and I thought this might be timely with all the talk of the recession and the spread and what's going on. This is from New York Federal Reserve Bank. And the study that showed, it said, again, the yield curve spread, we look at the 10-year and the 2-year. This looks at the 10-year and the 3 months. So if the spread is 1.21, which is positive, steep, that's again, it's not that steep, but still it's positive. There's only 5% chance of recession. And as we get to the negative, and that's been the talk in the past couple of weeks, we had looked at some of the statistics, we are going to be at 30%. Once you go to 2.4 spread, then that's about 90%. So if you like to have this handy, just, you can do it on your own, and it's very easy. You look at what is a 10-year yield and what is a 3-month. It's very close to Fed T-bill. So that's just a little chart. Another one I want to show historically where we stand from the gold to S&P ratio. And we see obviously 1980 with the Hunt brothers and everything. This is where we were. Today, this is where we are. So two things could happen. Either S&P has to come down, and it doesn't happen immediately, or the gold is going to go up, or both. So again, this is a chart you want to look at. This is where we were in 2011, and basically, which is about 4 times where we are now. We look at this, almost 18, 17 times where we are here. So a little history lesson. Silver is even more. I'm looking at, I've talked to you past 18 months or 2 years, actually, talking about the valuation of silver. This is where silver was in 1980, and it was at 0.445 ratio. Today is at 0.006. And we had the 2011 height, and that's like about maybe 6%, 6 times where we are today. So again, is the S&P going to come down? Is the silver is going to go up? I'm just showing you a chart. Nothing happens immediately, but everything is about valuation. And valuations, take their time, but they eventually do work. Something goes up this high, eventually has to come very sharply down. So last week we had all these banks, they had their numbers. So I'll just go through briefly through them. So, they had a rocky start to the year. So the year, with the, again, with inflation, with the interest rate increases, and, especially the shorter end was actually higher, and it was faster than the again the longer end. It has affected their basically their profit margins. They're coming from 2 years of fantastic, easy money just came in. So it was very good for them, but they were challenged. So as I mentioned last week, I said earlier, you had Citigroup, Goldman Sachs, Morgan Stanley, Wells Fargo. They all had their earnings, and basically the first quarter earning was, that was all drops, 42% drop at JP Morgan. It has been, again, I mentioned it had soared. So Citigroup had 46 plunge in first quarter profit. Morgan Stanley, smaller than expected, 11% drop. So one thing you will notice, and Goldman Sachs for the 43%, and it beat the Wall Street expectations. One of the interesting things was, look at this. It's strong performance in their wealth management. This should have been actually Thursday. I don't know why it's put Friday, but this is from Reuters. Management and their trading business. They had, a lot of these companies, they've had the trading business. So one of the problems that we had the COVID opening, but the problem is with the geopolitical problems, now it's not helping them with deal making, the investment banking side of things. So there's just a lot of volatility involved. So remember, a lot of these banks, you think of banking, and banking is not really a big part of these. Investment banking is huge business. And now for the past few years, especially since the 2009, when the whole QE happened, a lot of these large financial institutions, they do a lot of in-house trading, and they have obviously the algorithms and basically the computer programming. They trade tremendously. So that's where the profit is coming now. But again, that investment banking has really affected them. So I think this might be the last slide on the lesson of the week. I just thought that let's look at what S&P relative to inflation rate. So the best projection for the following 12 months happens when the inflation is very low, which makes sense, right? It's the profit margins, and the whole economy does well. So stock market does very well. The worst part is when the inflation is about 5 to 6%. Now, the interesting thing is when it's higher than 6%, which we are now, we just calculated, we said we have about 8.5% average. The market does about 8% 12 months down the road. And it could be also because of the inflation, there's a pricing power depending on the company, and that still keeps their profit margins higher, and basically depending on the wages to keep up. But this is just, again, a little history. Just wanted to share that with you. Oh, we got one more thing. We heard about, we had the Shopify. We hear about these splits gradually coming up. There was a study done in the 1980s, 1990s. In the long run, it doesn't make any difference, because when you split, the fundamentals don't change. Nothing changes. The earnings per share is the same. You just have more shares. So, but on a short run, it's more of a projection. It's more of a psychological thing. So this is from Bank of America Securities, and you see what they have done after the split of the stocks. So for 3, 6, and 12 months, they generally do better than what the market does. So, oh, this is biggie. Sorry, I thought that was end of it, but this is, I want to spend some time on this because it's very important, and I hope you put a lot of value on this as far as why S&P is so important. I mean, this is the most watched thing. As you can see, this is on Thursday. We had 1.829 million 533 contracts in a big S&P contract. So there's something called notional value, and notional value, probably familiar. When you buy an option, each option contract is basically, it is 100 shares, represents 100 shares. So if you're buying something at 20, or I mean, the price of something is 20, and you have 100 contracts, you basically, notional value is $2,000, right? So because that one contract controls that much of a stock in reality. So if the stock at $20 now, you have 100 times 20, 2,000. And when we look at one contract of, let's say we had 43.92, 100 shares, that's 439,259. That's only one contract of option of SPX. Imagine there was 1.8 million plus of this notional value. That's a tremendous amount of money being actually, this is again, being traded, is hedged, whatever it is. This is tremendous. On top of that, we have to add the ETF. So that's S&P. So S&P is at 437, and basically that times 100, again, that's 43,007. another over 5 million of these traded. So you add these two together, you see how much of actually notional value is being exchanging hands. And that's the reason you have to watch the S&P. You have to watch what is being traded and how that actually controls the market movement. The second thing I want to bring it to your attention, we've talked about this a few times. I've talked about gamma squeeze. We've talked about skew. Please, please pay attention to this. If there's, one lesson today, I want to understand that it's a lot of things are happening in the markets. We look at the charts, we look at what is happening. Oh, we say support and resistance, and we look at the fundamentals, we look at what is happening. But there's a lot happening with order flows. And with these order flows, what happens, that really dictates where you see the things actually, when you're looking at the charts, you see, oh, let's say S&P is at 4320, it's been going down, and all of a sudden with nothing inside, it actually turns around and goes up. So what happens? So first of all, there's a lot of hedging going on right now. With all the factors that you see, it's a tremendous amount of hedging by the institutions, portfolio managers, hedge funds. There's a lot going on. So they want to protect their profits. They've had such a nice 2 or 3 years. They want to protect that. So they do not come and just sell, let's say, Apple, or they don't come and say, well, imagine they hold 10 million shares of Apple or 50 million shares of Tesla or Amazon. They can't just go in the market and say, oh, sell this 10 million shares. So they, rather than doing that, they rather hedge themselves. So because of that, we've seen, the tail end of things. Sometimes things get skewed. So I've used this example in the past, but I want to do it again. Let's take a look at our big contract right now. SPX was at 43.92, which is right around here. And we know at 43.92, it's, or 43.90, it's kind of right at the money because they move at 5. You see in a normal world, it's almost very similar. You see that call is $21 and the put is about $21. So that's pretty good. So there's a little undervaluation in one. But what has happened is, if we go looking at, I just wanted to use $100 difference. So if I look at a 43.90 plus 100, that's 44.90. And if I go to that 44.90, I want to see how much is the option at that price. And it's about 40 some cents, or 40 cents. So somebody who wants to buy this call option is willing to pay 40 cents per contract for the something out of $100 out of money. If you go to the put side of things and go down $100 at 42.90, in a normal world, they should be really equal. They should have similar implied volatility, but yet the put side is about 145, and this is the bid. So it's about it's about, let's say 165, let's say 155 or so. This is more than 3 times what the call side is. And what it tells us is there's much more demand on the put side because of a lot of hedging activity going on. And because of that, that's how the skewness happens. And that's why when we have the fat tail, when we look at the charts and we see the risk that we're taking. So based on that, it tells us that, again, there's a lot of order flow coming to that. So we witnessed this last year in January, and we had the meme stocks on the other side. Or even if I go look at Tesla, Tesla still has more skewness on the call side than the put side. And the reason is, again, people, there's that FOMO, fear of missing out. They're so positive. So, but in general, you usually have skewness more on the put side than the call side, but because people, the fear overtakes the greed majority of time. So let's just look at this. So far, we know that there's a skewness, there's more hedging going on, and we've talked about gamma squeeze. So I made a notification about expected move. We've seen that when the expected move on the markets, which is these are the market makers, which they're mostly computers, by the way. These are the big, again, like Goldman Sachs of the world, and so they are the ones who create this environment for you to be able to buy and sell your options. So they bring the liquidity. So you've noticed sometimes when something starts selling off, it continues and then it stops. So let's explain that. And that's what I want to bring to connect everything together. So what is happening when I am individual A? I go and buy a put. That means I am negative about the markets. So when I buy a put, that means somebody else, let's say it's a market maker, is selling that put to me. So when they sell, remember, when we are selling something, when we are selling a put, our idea is that the market is not going to go there, and we want the market wouldn't reach there, the market will go up. When I'm buying it, I'm hoping it will push down and go to that direction. So as a buyer of a put, I am a negative. So that means I own a delta negative. When you buy a call, you're positive. You want things to go up. When you want things to go up, you're delta positive. So as the price goes up, your delta expands, you make more money. When you're negative and you think that things go down, you're delta negative. So I hope it's clear so far. So I'm, as a purchaser of put, I'm a delta negative. The option maker is selling that to me. So because they're selling, they have to take the other side. So they're delta positive. That means they're on the long side because they're hoping the markets go up. The problem is the market maker's job is not making directional calls. Their job is to make money based on the premium they receive and the bid and ask spread. So once they are delta positive, they have to negate that and that become delta neutral. The only way they can be delta neutral is by selling that asset. So how do they do that? They don't go sell options because then this cycle, vicious cycle goes again and again. They go and sell the futures. So what they're in reality doing to protect themselves, they're shorting the market. So here I am worried about market going down. So I buy a put. And the market maker, on the other hand, is worried that they don't want to be caught. So they're going and shorting the market. And that's what you see once, especially we go below some certain supports or we go, let's say, expected move, sometimes there's acceleration because what happens is the more worrisome there is, I'm going to buy more puts. They have to sell me more puts. By selling more puts, they have to go and short the market even more. So there is this continuous cycle that all of a sudden you see what happened once we broke that support, it just keeps going down. Then you see these reversals because maybe I wanted to, I'm satisfied. I maybe close my options now as a buyer of my put option. So as soon as I closed my contracts or I bought them back, now that these option or market makers, they don't have that obligation. So what they do, since we closed it, they go ahead and sell, or I mean, they buy back those shorts. And by buying back those shorts, now we have a buying pressure. And that's one of the reasons you see these reversals. Sometimes there are, especially like at 12:45, you see, you're looking at like the 5-minute, or you look at even sometimes on hourly, you see it's a big reversal. What happened? And they go vicious because now there's that buying pressure because all the other contracts are being closed. So that's called gamma squeeze. It's been happening and it's going to happen more because of the lot of hedging activity. So I'm sorry to spend a lot of time on this, but it is very important. If you want to be a successful trader, you have to understand what is happening with the order flows and how the market makers think. All right. I hope that was useful. All right. We'll spend another 5 minutes so I can let you go to enjoy your wonderful weekend. So we start as always. This is what we had last week. We had a short week. So we had Thursday, Wednesday, Tuesday, and Monday. So one thing we noticed that Monday's gap, close to half of it was closed, but there's this open gap. So it's a food for thought. Just put a notification whether that could be filled in the next few days. You see, we had a nice gap here, and that was filled the same day on Tuesday, so that was good. One of the things I mentioned last week is like the Easter. I don't know if I mentioned, or maybe I mentioned in my class. So usually pre-holidays, the mood is positive, and there's these studies done, and I've lived through that. It's Thanksgiving, Christmas, 4th of July, Memorial Weekend, Labor Day weekend. These are the times that there's like holidays, and market behaves a little differently. So what we found out in last 15 years, for instance, I found out that, you know, the day before, like Good Friday, when we have to close a Good Friday, we start, you know, the Thursday is the last trading day. If you buy on Wednesday morning and sell it on Thursday, generally is a profitable. And I mean, we were 15 for 15 for last 15 years. So with that in mind, I looked at just purely as a test. I want to share that with you. So I did go ahead first thing on Wednesday morning at an option which expired on Friday, well, Thursday actually, because we didn't have Friday. So it's a Thursday expiration. It was at the money for 39. And I put my targets, as you can see on Wednesday, and we go back to Wednesday. So this is Wednesdays. You see that was nicely done. So there's a lesson on this, because it was a positive and negative trade for me in a sense. And what is the negative side? So beautifully, everything was done. This was my 100%er target. It was hit. So I had my runner and I put it at 150%. And it missed just by little on Thursday morning. So a little greed there. This is what I forgot. I had put absolute and I did not put a runner. I mean, I didn't put a trailing stop. So basically my nice winner, it could have been out right around here. And I was busy. They were working around the house and all that. So I came back, and I think right around here, I noticed this was my my break even. And that was a lesson. And I didn't buy it back, just a lesson to remember. So it expired worthless. So I lost whatever amount that was. I still was positive for the week, but for that trade. But this was a lesson to know you have to watch. Just you put it on automatic, which is wonderful. But even when you come back first thing in the morning, check your trades, see open trades if they are still functional. As I've shared that with you, my biggest loss was in trading was on a trip to Germany in 2008, summer of 2008. I had trades on grains. I had trades on soybean and wheat. And I had put my stop losses. I knew I'm going to be on the plane. I believe we went to Dusseldorf, and from Dusseldorf to Hamburg. So I had a connecting flight. And basically what the mistake was, my stop loss was for the day. I had forgotten to make it good till canceled. And once we got to Germany, you know, we are with our family, my wife's family, oh, we have internet, not to worry. Well, it was a telephone line. And of course we have charts and trades, and it was couldn't reach out to my broker. And it took so many hours to just get, and it didn't work. I had to go to internet cafe. By the time it was all said and done, it was a few big losses. So the thing is, you want to check your again your trades to make sure they're done correctly. Since then, I always put things good till cancel most of the time on my exits. All right. The last but not least, I think this, just want to share, this was a stock of the part of a trade of it's a shipping company from Greece, the Star Bulk. And so, after we recommended, it had a big drop, and that's what I talked about, bulk dry. So I did go ahead and just bought some shares in it, no options, just see how that will work. So, and so far it's working. On Thursday, when everything was down, we had a big, I think we were up like 8% or so. So, and this is where I got in right after we had a sell-off. I watched it for reversal, and that's when I got it. All right, quickly, just the ETF of the week. I thought rather than just going to a lot of ETFs, I think this might be a good episode we add. Just see which ETF was the winner last week, and it was the metals and minings for a good reason. They were up 6.9%, and these are a couple of their holdings, CIX and RYI, obviously with the energy and all the minings. And then the weakest one, which was the ARK FinTech Innovation, ARKF, they were down 5.6%. So, and they had a Coinbase and then the shares of Stone Company. The other ETF, we had a class on analyzing mining sector, the basic material about the mining industry. And since we've done that, I think was somewhere around here. I think GDX was about 30 or 30 plus, and we actually hit over $40. So it's been a nice trade. You see, again, this 21-day moving average has held very nicely. So it has been a good trade. So that's been a good ETF to hold for the last couple of months. As far as the stock of the week, I thought I'd share just, this is as of Thursday, the most unusual option trades that happened on Thursday. So just to tell you, this comes from Market Chameleon. So you have access to it, it's free. So you can see, you can do bar chart, also has unusual option trade. You use Sizzle Index, that's also, it's a great one. So you get some unusual option trades. These are some of the, you can see there's a lot of earning related, obviously, and but just a food for thought. Last segment, but not the least, is I decided to choose for squeeze this time is the S&P Materials Select, and these are they only came with 4 companies, so you can look at them yourself. This is, we talked about earning strategies. Here we are. You see, my God, this is the meat of things. It's a lot are happening, from energy to technology, to medical and healthcare, to insurance and financial. Still, we see that Bank America and Charles Schwab and BNY and Synchrony, they're all coming Monday before the opening. And also Cypher. And then there's more banks, and then we start getting to energy, Halliburton, Johnson & Johnson, the travels and the insurance side, Netflix, that's going to be a big fallout after the close, IBM, and Interactive Brokers again in the financials, and then the P&G, it's a little more boring, and Baker Hughes, Anthem. And then here we are, Wednesday. This is going to be a fun day after close with Tesla. Alcoa, I just shared with you, I've shared with a couple of you. Alcoa used to be the first ones coming on at the end of the first week of April or every quarter. As a trader or as an investor, we would look for Alcoa because that will be the start of the earnings season. And let's say it was last Monday would be the one. And so we will just wait. It will be 1:30 and it will come out with the 1:15 or so. It will come up And then after that, the CSX will come. So these were the pioneers. Now everything is mishmash. Everything is just, changed. So, but this was not that the big company, but it was the actually the flag holder. And that's what we were watching. So now it is on April 20th. It's coming up. So it has lost it's really the shine. And of course, we have the AT&T, and then we go to Snap, and there's a few on Friday. We have Cliffs and Verizon, American Express, Schlumberger. So the other one I want to pay attention to this. I know I put this for you because you want to look at these average moves. There are some big ones. So you want to see, we can use that expected moves. We talked about some of the strategies. If you want something really volatile, these are the good companies to follow as a candidates. So, and then if you want to see the 2 weeks or 3 weeks from now, just go to that individual, go to Earning Whispers and screen for that. So these are just this coming next week. You see, we have Alcoa. Its average move is 8.1%. Netflix is 9.7%. Even Tenet Healthcare, you can see so healthcare is only 4.2. So just take those into consideration. And I hope you read these. These are as a reference. These tell you what the market's, expecting, and what, as far as activities, what's going on. So again, some of the big ones coming up: Bank America, Netflix, Halliburton, Charles Schwab, Cleveland Cliffs. It's a big name, actually. It's been hitting all-time highs. Johnson & Johnson, American Airlines, Snap, Bank of New York, and of course, Tesla. So excellent. All right. Appreciate your attention. I hope it was useful. So with that in mind, we can stop the recording, and I wish you a wonderful, wonderful Easter weekend. Thank you so much.